Hello, accounting superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. I'm glad you're here. What we're going to learn today is how to calculate interest. All right, so it's something pretty important, something you're going to use over and over again. It doesn't matter what you major in, folks. So this lesson is designed for people that are probably in about their third or fourth week of accounting, and are probably in about chapter 3 of their textbook, which is not an easy chapter. Everybody struggles with the third chapter in accounting, but don't be discouraged. Things get easier after the third chapter. So here we go, folks. We've got when we get to a construction, they have a loan outstanding of $900 at an interest rate of 5%, and the time is 1 month. Okay, so what's gone by here is 1 month has gone by. And the key to this is to think, well, how many months are there in a year? 12. There's 12 months in a year, so only 1/12 of the year. And the reason why that's important is because interest here, the 5%, that's based on an annual basis. So we need to get the number of months on an annual basis. That's why the number 12 is important in this case. So coming down here just a little bit, here's how you calculate interest. It's really easy, guys. There we go. I equals PRT. I party. All right, that's how you remember it. So I equals PRT. So here's how you do it. Interest equals the principal, which is $900. Times the rate, which is 5% on an annual basis here, 5% annual basis. And the time is going to be 1 month out of 12. All right, so we need to make those months on an annual basis also. So here we go. Interest is going to equal $900 times 5% times 1/12, 1 month over 12. And if you do the math, you get $3.75, which is not a lot of money here, but I'm trying to keep the numbers really small, so that way you can focus on the concept and not worry about the numbers so much. But that's as difficult as the math gets right there. Now coming down here, guys, so what would happen is when we get to a construction, needs to enter into its books this interest that is due. It's not being paid, but it's just due. So here's the journal entry. We've got interest expense of $3.75, and we've got interest payable of $3.75. Now, a good way to remember this is that 99% of the time here, expenses are going to be debits. All right, and so interest expense is going to be listed first as a debit for $375, and this interest is due. That's why we have interest payable of $375. All right, it has not been paid yet. It will be, but not at the end of the year. All right, so coming down here, what I've got is I've got a little partial schedule worksheet thing, and this is how accountants did accounting a long time ago, like 50 years ago, before computers were used. And the nice thing about this is it helps you visualize what's going on, and that's why I'm including it. So here's what's happening, folks. Interest expense here, well, what's going on is the company already has $20 of interest expense. Now that $20 does not include the $375 up above, all right? It's kind of like a beginning balance in a way, sort of, kind of. That $20 does not include this adjusting entry that we're just doing. So here's what you do is in this adjusting entry here, we've got interest expense debited for $375. So let's put that down here in the adjustments. And you can see that it's the color green up here. I made it match here. So that way, hopefully you'd see there's a connection here. So we've got a unadjusted trial balance of $20 debit and the adjustment of $375, and if you add those together you get $23.75. all right, a debit plus a debit is a bigger debit. All right, now you've got to think, all right, well, what financial statement does this go on? Well, I hope you know by now there's only two things that go on the income statement. Only two things. What are they? Revenues and expenses. That's it. Revenues and expenses. Nothing else at this point. Nothing else. All right. So So you might ask, well, what column does this go in? Does it go in the debit column or the credit column? How do I know? And don't debits and credits need to balance or something? Here's all you do. It's really simple. In your adjusted trial balance, you've got a debit of $23.75. So just move that $23.75 to the income statement right there as a debit. All right. Don't worry about debits equaling credits and that kind of thing, because we're just seeing just a little tiny part or piece of the financial records here. So coming down to interest payable. Well, with interest payable, they have a zero balance here in the unadjusted trial balance, but we are going to credit interest payable for $375. So let's put $375 right there. There you go. So here's what's happening. A zero credit plus $375 credit is going to give us a credit of $375. All right. There we are. Now you have to think, well, what financial statement does this go on? Does it go on the income statement, balance sheet? Well, a good way to remember is that only two things go on the income statement: revenues and expenses, and payables are not either one of those. So the payable is a liability, and so it's going to go on the balance sheet. And you might remember it this way, that there are three things that go on the balance sheet: assets, liabilities, and equity. All right. Interest payable is a liability. So let's go over here to the balance sheet. So you might be wondering, well, do I put it under the debit column or the credit column? Aren't these debits and credits supposed to balance? Well, all you do is, since this is a credit balance under the trial balance here, the adjusted trial balance, just move it over here to the credit side there. That's all you do. And you might say, well, my debits and credits don't seem to balance here. Well, they won't. This is just a worksheet to help accountants visualize and make adjusting entries. And I don't think that any accountants still use these worksheets. I could be wrong on that. Back in the old days when I did accounting, we certainly did. And it was taught in class, in school quite a bit. And I think it's useful because it helps a person visualize what's going on with these adjusting entries. Alrighty. Well, I hope this helps here, folks. And if it did, let me know. Hit that like button, hit the subscribe button. And until next time, over and out.